Good afternoon, and thank you so much for joining us for this webinar today on putting your 2019 contribution to work. I'm excited to talk about this topic because I know a lot of times people are anxious to get their contributions in, but with a self-directed IRA, it's really important that you work on putting your contributions to work for that account. And so meaning that that money is going to come to Advanta, but then it is just going to sit. It's not going to earn anything. It doesn't sit in an interest bearing account. So you're going to have to put that money to work in order to have earnings go back to that account. And so we're going to talk about that today because not everybody is starting with an old employer plan or has been contributing for years, or maybe even just simply wants to diversify. Maybe this isn't the time to pull money out of the stock market, but you're still anxious to get your 2019 contribution in and you want to make investments. So we're going to show you here at Advanta what we see our clients investing in when they're starting with contributions. So my name is Larissa Greene. I'm with Advanta IRA, and also joining me today is my partner and associate in Atlanta, Reneika Lightbourne. How are you doing today, Reneika?
I'm doing good, Larissa. How are you?
Great. Thank you so much for joining me.
Absolutely. Hope everyone's doing well and staying healthy. And again, Larissa mentioned I'm in the Atlanta office, so I've been with Advanta for a little over 9 months now as an employee, but I'm also a client of Advanta for well over a year and a half. So self-directing is something that I personally do and strongly advocate, and I look forward to being part of this call today.
Thank you so much, Reneika. And I've been with Advanta for I guess almost 9 years now, my goodness. And we work here at Advanta, really gearing all of our seminars towards education. All of our marketing is geared towards education, and so that's really what I've been doing. I worked doing back office things like paying expenses for clients' accounts and receiving income. I've done transactions and opened new accounts, helped people with transfers. And so now I've been doing marketing, education, and business development for probably about 8 years now. And Reneika and I are very fortunate because we get to do the networking for Advanta. So we're out there, we're working with investors, we're speaking with people, we get to attend classes and seminars just as our investors do. And so we have this really awesome role with Advanta where not only are we out there meeting people, but we also get to educate ourselves through the different avenues that you guys are doing as well. So who is Advanta? Well, we have our office there in Atlanta, and we're also in Largo, Florida. And of course, right now we're sort of remote here, so we're working from home. Reneika and I are logged in from this call, and just as many of you guys are, just sitting on your couch listening. And so, we have been doing self-directed retirement accounts for about 18 years now, and we've always done or handled qualified plans, meaning that we can help with your IRAs, your 401ks, your HSAs, your ESAs, and we'll talk about that in just a minute. But we only handle self-directed assets. So we don't put your money to work for you. You have to find those investments that you would like to make. We help you get them done. So the IRS is going to require that you have a third-party administrator like Advanta. When you're making alternative investments, that's what we do. We can't help you with personal funds. We don't handle any of those things, but what we can do is help you when you find the investment for your account, get it properly titled in the name of the IRA or whatever type of account it is that you'd like to hold with Advanta. We are a little bit different than our competitors in that we offer the ability to work with a single individual at our office. And so when you open an account, you're assigned an account manager, and that account manager will help you make investments, make contributions, help you understand the rules. Anything that you need for your self-directed account is going to be through that single individual, which I think really gives you the opportunity to get to know the person that's helping you with those investments.
I know, Larissa.
Go ahead.
Oh, I was going to mention, I know you mentioned that our educational platform we're really committed to it. It's second to none. Part of our commitment to educating our clients and the general public about self-direction. You can always access our recorded webinars and seminars using our on-demand YouTube learning channel. Also, too, I encourage clients to, or our guests in general, just to visit our website, check out our blogs. It features anything and everything relating to self-directing. And if you have any questions, we'd be more than happy to assist you with that.
Exactly right. And that's a great point, Reneika, because even this webinar is being recorded and you will be able to access it afterwards. So if you want to share it, if you want to review it, all of our webinars are going to go up to that YouTube channel. And so they're always available. And so we're going to talk about some investment strategies today that we maybe don't go in much depth, into much depth with, but we might have a webinar on that topic. And so when we get to that list of investment strategies for your 2019 contribution, we'll kind of give you some definitions and some ideas about how they work, but then we might have a webinar that coincides with that topic, and so you could definitely check that out. So when we're teaching, when we're talking about the different types of investments, we talk about the rules for self-directing, the strategies, the process for these accounts, but what we don't do is provide legal, tax, or investment advice. And so what I usually tell people is go ahead and ask your question. If it's something that we can't answer, then we'll let you know, and maybe we can connect you with a third-party professional that can help you with those questions. So, if you say to me, is this a good investment? I'm going to say, I'm sorry, I can't analyze and do due diligence for you, but maybe I have somebody I can connect you with that can. If you ask me, hey, what are the rules? How do they work? Then I can definitely help you with that. And on that note, I also want to mention that we do keep everybody muted on the webinars, but if you have questions, we would love to take them throughout the webinar. At any time, type them into the question box and we'll answer them as we go. I think it's important, and Reneika, you can tell me maybe what you're hearing on your end, but to just really give you an idea of key points. And the reason behind that is because a lot of times the information that we share through our classes it's a lot of information. It can be overwhelming, especially when we talk about the rules and strategies. When we get into the case studies, it might be hard to process all at once. So here's the 3 key points that I like to mention because of that. And so, if you take anything away from this webinar, I hope that it's these 3 key points. And then I hope that with any other questions, you feel free to reach out to Reneika or myself. But any IRA or former employer plan qualifies. So although we are talking about contributions today, I just want to make it clear that any type of retirement account, whether it's an IRA or a former employer plan, it can be self-directed. You choose the investment, so we already mentioned that a couple of times, but you find the investment, and then all expenses are paid by the IRA and any income is received by the IRA. And again, I like to make those points because one of the first questions I always get is I've heard it has to be a Roth IRA. Is that true? And it's not true. If it ends in IRA, it can be self-directed. Another big question that I get is, how do I pay back this loan from the IRA for this investment? And it's not a loan. It's the IRA making the investment directly. Reneika, what kind of things or what kind of questions do you hear pretty regularly on these types of accounts?
So typically I tell people, like you mentioned, if you have an existing, IRA account, at another brokerage firm, or if you have a former employer plan, whether it's a 401k, 403b, TSP type plan, absolutely you can roll those funds over to be able to self-direct and have greater control. The example I typically give people in terms of referencing, if your IRA make a purchase, for example, if you're a real estate investor and you buy 123 Main Street, the IRA is actually purchasing that property. And then, of course, if there's whether your strategy is rental or it's a fix and flip, all of the profits or rents from that investment would flow back into your IRA account. If you have expenses like, say, property taxes or insurance, or you have to pay contractor, the IRA would be responsible for making that. So typically, I would just kind of give them an analogy of all of the expenses, all of the profits flow back into the IRA, all of the expenses are paid by the IRA.
Yeah, and that's a great point because I think it's very normal for us to consider stock in a retirement account, right? So we think about an IRA or a 401k and we think mutual funds, we think stock, and those things are automatically titled properly when they're purchased through the broker. They're automatically held in a retirement account. The earnings are automatically returned to the retirement account. All of that stuff is sort of set it and forget it for us. But when you're making investments into things like real estate, that is actually true for these accounts as well. So we're going to help you get it titled properly in the name of the IRA. We're also going to receive the income for you and help you pay expenses. And so those things are all done through the retirement account, just like they would be if you were investing in stock and mutual funds. So that kind of gives you an idea of how it works. And I did see a few questions pop up on here. Somebody's asking if it's too late to make the open and fund a Roth IRA for 2019. And the great news is it is not too late. When we get to the types of accounts, we'll talk about a few of the deadlines that maybe have already passed to open certain accounts, but a Roth IRA, it certainly is not too late. You can still open and fund it for 2019. And the good news is that date was also extended based on what we're experiencing here in the United States and around the world right now. So thank you for that question. I saw another question pop up about handouts. I did not do any handouts. However, I'm certainly happy to share the slides with you. So if you would like the slides, please feel free to reach out to myself or Reneika. You can email or call us at the office and we'd be happy to send out those slides. You can email me at lgreene@advantaira.com. That's L Greene with an E at advantaira.com, or Reneika. And Reneika, you want to share your email address?
Yes, it's R Lightbourne, LIGHTBOURNE @advantaira.com. Feel free to reach out to me and I'll be more than happy to assist.
And you want to explain, Reneika, why people really just haven't heard of self-directed IRAs?
And I think you mentioned it just briefly. Unfortunately, most people, if you haven't heard about self-directed, it's relatively a new term for you. The reason being is most common IRAs are held by the larger banks and brokerage firms, and their business model we know is stock, bonds, mutual funds. So they're not going to let you know that you actually have other options. But in actuality, the IRS do say that you have a long list of things that you can invest in. And believe it or not, self-directing has been around for a very long time, since the 70s. And as of now, less than 4% of retirement accounts are actually self-directed. So it's still a great opportunity for many people to take advantage of.
Yeah, that's a really good point. And, when we're talking about the different types of accounts, another question popped up on 401ks or employers plans, and the individual is wondering if you have to be a certain age in order to roll money out and self-direct. And so here's kind of the way the employer plan works. If you are employed currently and an active participant in that plan, it's very typical that the employer's plan does not allow you to move any portion of it to an IRA. Once you've severed ties with that employer and you are no longer participating, at that time you are free to move that account regardless of your age. So whether you're 59 and a half or below that age, if you have an old employer plan that's just sitting, you can certainly roll that into an IRA. Or if you're over the age of 59 and a half, you certainly can take those funds. Now, if you're currently participating in that plan, you're still with your employer, then it's really going to be dependent upon the employer and their plan rules as to whether or not they allow you to move those funds, some or all of those funds. So you really, if you're still participating, you'll want to reach out to them directly to find out what the rules are. But old employers plans of any kind can absolutely be rolled into an IRA and therefore self-directed. And so here is the types of self-directed accounts. And if you'll notice, and we mentioned that you certainly could have a Roth IRA and self-directed, and we have an example of self-directing a Roth IRA later on in this webinar. But you certainly could have a Roth, but it can be a traditional IRA. As a matter of fact, I typically see most often traditional IRAs. How about you, Reneika?
The same here. Mostly, most people have traditional IRA, but I think a lot of people are leaning towards the Roth because they now understand like the power of using that Roth account, paying the tax upfront, knowing what your tax liabilities are, with the intentions of using what your skill set, your knowledge to kind of grow your account. So by the time you reach retirement, you don't have those tax implications.
Right, exactly. And really probably the reason that we see more traditional than we typically do see Roth is because a lot of those traditional accounts come from old employers' plans. So, if
That's
you work with a
exactly
company for a lot of years, they make contributions on your behalf, you make contributions, and then once you've severed ties, it will typically all be pre-tax. Of course, there are 401k plans now that allow Roth contributions, but that wasn't always the case. And so typically you're going to see that those funds are all pre-tax and then therefore go into a traditional IRA. There are some other types of plans that we have up here for everybody's sort of informational purposes, but employer plans that include IRAs or things like simple and SEP IRAs, and those are great for small business owners. And sometimes when you work for a small business, you have a SEP or a simple IRA as well. And then of course, if you're self-employed, a solo 401k or a one participant plan is something that a lot of investors favor for themselves because of the higher contribution limits, and you'll see those in just a minute. But also up here, I have health savings accounts and education savings accounts, and I think many people don't know that you can self-direct those accounts. And so when your contribution limit isn't much on an annual basis to a specific type of account, you really want to control your earnings for those accounts. Self-directing them is a great option for you. Because the rules for self-directing these accounts are exactly the same as IRAs or 401ks, we can hold them and help you with that. I personally don't see many education savings accounts opened. I maybe do help clients with a couple a year. I think maybe because of the contribution limit. Do you open many education savings accounts, Reneika?
Um, very sparingly, far and few in between. But again, to your point, it's a great, if you have children, you can put, that 2,000 a month, 2,000 a year per child, and be able to again partner it with one of your other IRA accounts. But no, I see it, a couple times a year. Same thing with the health savings. It's a little bit more than the educational, but not compared to the traditional or the Roth account.
Mm-hmm. Exactly. So,
I do like the individual solo 401k option. To your point, you're able to put a lot more away, stock a lot more away, but also too, it gives you a lot more flexibility in terms of the different things that you can do with it. Very similar to a traditional 401k plan.
exactly right. In our, we now have the ability, and we'll talk about, we're going to move on to contributions here, and just kind of show you guys that with contributions, you can see the annual limit for each of the types of accounts. And with the solo 401k, we now have the ability to offer you for 2020, starting in 2020, the ability to make after-tax contributions as well, which will help you get to that total limit allowed by the IRS each year. So if you have questions on that, please reach out to me outside of this webinar. I'm not going to go into it too much today, but of course we do webinars on solo 401ks where we'll explain that in more detail. But we now have that ability for those contributions. So again, the 401k or one participant plans, we have the ability to offer the contribution where you can make after-tax contributions or a third type of contribution outside of your normal employer and employee contribution. So you can see here, again, these are contribution limits for 2019, and we're talking about making your 2019 contribution and how to put it to work. So I left these limits for 2019, and I know some of us are still scrambling or working to get our contributions in and file our taxes, and of course now we've been given an extension. But there's a contribution limits for you, and on my next slide I also show where you can access the table for contribution limits of 2020, but here they are for 2019.
And that
And you can,
extension has been for July 15th, correct?
yes, so July 15th is when tax filing has been extended, and so therefore contributions to your IRAs, as long as the IRA contribution was for April 15th. And I just want to clarify that because you're going to have different types of accounts that either needed to be opened prior to December 31st or earlier in some cases, or where you can make one contribution but not the other. So let me run through the list real quick and give you an idea for each type of account here. So with a traditional or a Roth IRA, again, we talked about this, it's not too late to open and fund a traditional or Roth IRA for 2019. So you can still do that, and you'll have all the way up until July 15th to make those contributions. And open the account. So just keep in mind that, you know, if you're not sure if you'll have the ability to contribute 100% of the amount you would like to, up to the 6,000, and you're really waiting until you get to the point where you're ready to file your taxes, you can just reach out to us, open an account, make the contribution, and then, you know, file your taxes. So if you haven't filed, it's not too late to contribute for a traditional or a Roth. The same is goes for the SEP IRA. So SEP IRA is a great employer plan. So if you're a small business, sole proprietor, an independent business owner, you can open and fund a SEP IRA for 2019. I just helped a client do this the other day. Your contribution limit is going to be 20 to 25% of your compensation, up to 56,000. So you'll do those calculations with your CPA or tax professional, and then make that contribution to the SEP IRA. The simple IRA did have to be opened up prior to 2020. So if you haven't opened your simple to make those contributions, you have missed the 2019 deadline for that. If your simple is existing, then you will have the ability to make those contributions. With the 401k, you have a unique opportunity to make the contribution for the employer side of the 401k only if your plan was open as of December 31st. So unfortunately, if your plan was not opened as of December 31st, you are unable to make that contribution. And your employee contribution really should have been made in January. So we're talking about the employer contribution for the 401k, and that can be made at the employer's tax filing deadline plus extension. So you still have time for the employer contribution up until tax filing plus extensions for the 401k. The ESA and HSA can both still be opened and contributed for 2019, and the HSA does have some exceptions. So I'm not going to go into that too much. We do have an entire webinar on HSAs where our partner Alex talks in detail about what requirements you must meet in order to still make your 2019 HSA contributions. If you're interested in that, we certainly can make sure, again, to get you the link to that webinar, or you can search Advanta IRA on YouTube and find that information there. Oh, sorry about that. Okay, so we talked about the contributions, and really what we're talking about when we say contribution limit is the amount of money you are limited to put into your account on an annual basis from your pocket. So I like to specify it that way because a lot of times people say, well, what if I own a rental property and that tenant pays me $1,000 a month? You know, so yearly I have $12,000 in earnings going back to the IRA account, and it's important that we differentiate between earnings and contributions, because that is not a contribution to your account based on IRS rules. So if you're taking money out of your pocket and you're putting it into your IRA account, that's going to be your contribution limit. They only accept contributions basically in the form of form of cash, essentially, meaning that you can't contribute an asset, you can't contribute stock. It has to be money into the IRA account. So if my contribution limit for a traditional IRA is $6,000, that means I can take $6,000 out of my bank account and put it into a retirement account, into a traditional or Roth IRA. But when any investment that I put in or purchase with that account, those earnings are considered unlimited. And you can see that down here at the bottom of this slide: transfers from between IRA accounts, direct rollovers from old employer plans, and earnings are unlimited in retirement accounts. It's the contribution that you are going to be limited to. And again, if you're looking for those 2020 contribution limits, there is the link for the website where you can access those, or just go to advantaira.com and search contributions, and that will pop up for you. So alternative investments are really not just for larger balance accounts. Every week I go to a meeting here in our local area for exchangers where they are making deals on sometimes large amounts, but oftentimes smaller amounts as well. Many people at the exchange meeting that I attend are using their annual contribution, or they're using, you know, because they have X amount of dollars out in one project, but maybe they have $5,000 sitting in their bank account they wanted to earn, they want to put it to work. And so many times investments that I see occurring at this meeting are smaller balances. And so that just proves that you don't need a whole lot of money to get invested through alternative assets. So self-direction is not an all or nothing strategy. I know right now a lot of people are not looking forward to moving any money out of the market. There are a lot of people in that position. And so if you still have to make your 2019 contribution, you don't have to move an IRA to Advanta. You can start new. So start your new account, make your contribution, make your investments. Diversify your portfolio. It's not an all or nothing. Get some other alternative assets in there. And again, those investments are going to be up to you. And we're coming up on a slide where we're going to talk about the asset classes.
And Larissa,
Consider, yep.
if I can interject to your point, I usually tell people it's an additional tool in a toolbox when it comes to self-directing, not to pit it against the stock market. Self-directing just gives you, that ability to pretty much, truly diversify your account. And regardless of how small your account is, the point is to just start. So typically there's a misconception, or clients that I speak to sometimes, or potential clients feel like, okay, well, I only have this amount. Well, you can take that small amount and absolutely grow it to be able to put it to work for you.
Exactly right. Exactly right. And so, and we're going to give you, so let's talk about the assets, because I know I had some questions pop up on the chat box about investments as well. So we'll get those answered here on this sheet. But Reneika, why don't you tell us what you're seeing as far as investments where maybe you don't need $100,000 to make those investments?
I've assisted clients who are, specifically interested in, options contracts, or, maybe you're a wholesaler, definitely tax liens. I know here in Georgia, tax liens is a big real estate related asset that clients are interested in, and you don't have to have a pretty large sum of money. You can to get started with, with an annual contribution. Definitely, I see people who are interested in investing in precious metals, gold and silver right now. Again, we don't give tax, legal, or investment advice, but I do have clients that have been inquiring about, possibly purchasing precious metals because the price, it's within that price point for them.
Exactly right. And that's a good point too, because something like precious metals, if you have X amount of dollars, we talk about contribution limits, being something like $6,000, but let's say that you don't have the ability to contribute the whole amount of 6,000, then you might be looking at things like tax liens or precious metals, where you can invest the amount of money that you have and, make those investments and feel secure in those investments, and that you have, that the investment, you can put 100% of those funds, if you will, into that asset. And so tax liens are a great investment. I don't know about the Georgia market, but I know here in the Tampa Bay area, you can buy a tax lien for, $600. So you really just don't need a lot of money for, any of these investments that we have listed here on this screen. So I know we think about a mortgage and we tend to think hundreds of thousands of dollars, but that just doesn't need to be the case. And certainly you might have a real estate investor, for example, with a property that's free and clear, and maybe they want to do some upgrades to the property before they get ready to sell it. And so they're looking for, a $10,000 loan. It might be a first position mortgage in this case, maybe it's a second position, whatever it is that you feel comfortable with. Then you can go ahead and make that investment through the retirement account. I also have on here wrap loans. And again, I'm not going to go into the specifics here, but if you guys want to learn more about wrap loans, I did a webinar with Dorsey Bodiford Cooney last year. It is posted to our YouTube channel and our website, where she talks about how wrap loans work. But again, you just need a little bit of money, a little amount of money to get started doing wrap loans. It does take some knowledge, though. I mean, this is going to be more of what I would consider an advanced strategy for investing, but it's essentially finding a partner that has more money to lend. And so if somebody is looking for a loan of, say, $100,000 and you have $10,000 in your retirement account, you might find a an investor that has 90,000, where you can partner those funds, so to speak, in the form of a first mortgage, and you're in second position, and wrap that first mortgage with the second and have the earnings go back to your IRA there. So you're basically earning on the spread. So we see people do use that strategy.
Yes. And to highlight a little bit more on partnering, again, it doesn't have to be your money. You can be the person that's bringing the knowledge and the skill set to the table. The next person that you know, maybe you have, a family member or a business associated who has an old 401k that's just sitting, and you can elect to partner together. And I know Larissa's going to talk more about a case study later in the presentation about partnering, but it doesn't have to be your money.
Exactly right. Exactly right. And so, that's really where networking comes in, because a lot of times people will ask me, well, where do you find these people that you can work with or partner with? And so, just as Reneika and I do, then I would suggest that you look for real estate groups in your local area if you're looking to partner on real estate, or if you're looking to learn from someone who, invests in precious metals or cryptocurrencies or options or futures, any of the things that you are looking to invest in, then find like-minded investors and do some networking, because you're going to find there's a lot of knowledgeable individuals out there willing to share what they know. And so I've met so many very nice people over the years that I've been networking for Advanta. I'm sure, Reneika, that you've had the same experience.
Yeah, absolutely. There are a lot of different rear groups. You always hear the saying, your network equals your net worth. And absolutely, that saying is absolutely true. So I implore you to, whatever it is that you're pursuing, whatever you're interested, find, like-minded people that are doing the same thing that you want to do to help you get to where you need to go.
Exactly, exactly. And so while we're sort of here on the page for assets, I'm just going to cover two more asset classes that we see, and then I'll answer some questions here on the question box. But so we have seen equipment leasing, and so again, something that doesn't take a whole lot of money to get started. We've seen people do large format printers, ATM machines, farm equipment like tractors, or maybe even purchasing lending money for those types of machines. And so we're seeing more and more of that here at our Largo office for sure. And then foreign currency exchange, we do see this from time to time. And although there are platforms out there that allow you to trade and buy foreign currency, they actually don't, or they're not interested in holding retirement accounts. They don't want to handle the reporting that goes along with it. So instead, you have a self-directed IRA, and therefore your IRA will open an account with that trading platform in the name of the self-directed account. And so actually, we work well with those types of businesses. They realize how the account needs to be held. The money comes from us and goes to your profile with them, and then you're able to make those trades and purchases. And so that's basically how it works for futures as well. We see a lot of that at Advanta because those platforms really just aren't interested in holding IRA accounts. We had a question pop up about the losses, because the gains from a self-directed account go to the IRA. That means that if you had losses in the account, you would not be able to take them personally for tax purposes, and that's correct. But in defense of that comment, I would just like to point out that that is the same when you're invested in mutual funds and stocks as well. So, a lot of us are experiencing losses right now in our retirement accounts if we were holding things like stocks, bonds, and mutual funds in anything but market based, and that's still true. Nothing changes for the rules on these accounts. And so if you're experiencing losses in your 401k or your IRA right now based on the market, when you're holding a self-directed asset, those losses are also for the account just like they are now. And so nothing really changes there. I had another question about raising capital. How do you raise capital with private money through self-directed accounts? And honestly, it's going to be up to you. So we aren't putting borrowers and lenders together, so to speak. But again, that goes back to networking. Look for groups of individuals in your area that are getting together based on the type of asset that you're looking to raise capital for. And the idea that if you explain self-directed accounts to individuals thinking about investing with you, the idea is that they are likely going to have more liquidity in their retirement account than they do in personal funds. And that just tends to be what we find at Advanta. People that like to sort of advertise, so to speak, the idea behind a self-directed IRA to investors they raise capital from. They tend to have more investors or more money come from individuals that use self-directed IRAs. And again, I think that's just based on the fact that IRAs tend to be more liquid. I had a question on what cautions are there in a self-directed IRA, and I think we sort of already covered that as far as gains and losses. And again, I would just put that back on to you as the investor. You want to make sure you're doing any due diligence for any investments that you're making. If you have questions on types of investments and strategies and whether or not they work within the rules, that's of course something we can help you with. But so for example, if you're going to lend money in the form of a mortgage, then you may want to not only do your due diligence on the individual that you are lending the money to, but also on the property, because should they fail to pay, is that an asset that you would be okay ending up with as part of your portfolio? And I think that's very important. So remember that we're not going to do your due diligence or tell you whether or not this is a good investment. So, there are, and we've disclaimed that. And so that's really a big part of the caution for a self-directed IRA, is that you want to make sure that you're familiar with the investment you're making, that you're comfortable with the investment you're making, and that you've done all of your due diligence. Reneika, you want to talk about the investment restrictions?
Yes. So when it comes to self-directed, Larissa and I, we've mentioned, there's a long list of things that you can invest in. The IRAs actually, there's only 2 investments you cannot, you cannot purchase in your IRA or in your retirement account. That's life insurance and collectibles. Collectibles being anything like wine, antique art, stamps, coins. Some coins are allowed based on the actual trading value of that metal. But I tell people not to let the few restrictions that the IRS has in place prevent you from taking advantage of this powerful strategy. The analogy that I typically give, it's very simple. If you're driving a car and the light says green, you go. If you're driving and the light says red, you stop. So same thing. There's a few restrictions: life insurance and collectibles. Everything else is on the table for you.
Exactly right. Yep. And I like to kind of, explain to people just about the sky is the limit with a self-directed IRA, as long as you're making the investment for investment purposes. So I think that's a very important statement, because if you start thinking, okay, well, how can I help my son or daughter? How can I get a vacation home? Then we're not really talking about investment. A lot of times people will say, well, if I lend money to my son, it'll be in the form of a mortgage and he'll pay fair market value. But then I would pose the question to you, what would happen if your son could not repay? And so now we're talking about possibly the reason that the IRS does have rules about who you can transact with, so to speak. And so we're really not going to go too much in depth on the rules today, but if you go to our YouTube channel and check out self-direction, back to the basics, self-direction 101, you're going to get that information there. And, or of course, you can reach out to me or Reneika for more questions about that. So we're going to jump right now into the case studies and talk about putting your 2019 contribution to work and how you can make the most out of that money. And again, remember that we're not selling you any investments. We have nothing to sell. We're basing these case studies on what we have actually seen clients do over the years at Advanta. And some of this is something we see done daily, and some of it is maybe a little more advanced and not as common, but certainly investments that can be made with self-directed IRAs. So the first one that we're going to talk about is a real estate option. And so real estate options, I do consider more of maybe an advanced strategy, something that you would want to educate yourself on, but the potential return on an option is awesome if you understand the concept and know the investment really well. You can do really well. But of course, there's downsides to all types of investments, and so that's important to understand. So an option right here on the slide, I basically am just defining the option for you. It's a right, not an obligation. It's considered a unilateral contract. So for example, when you purchase a house, when you go under contract to purchase a house, it's a bilateral contract. You both, the buyer and seller, have an agreement to perform on that contract. But an option is unilateral, meaning the person that is buying the option has a choice whether or not to exercise that option, and it's usually within a set amount of time. So the optionor is the one who gives the option or is the seller of that property. The optionee is the one who gets the option or is the buyer. And so I'll give you an example of this. But with an option, the optionor, in exchange for some consideration, which can be cash but doesn't have to be cash, sells to the optionee the right to buy some or all interest in the property within a specified period of time. And so this is a lot of information again, but I'm going to give you an example and hopefully that will really answer your questions there. So here's my example, Susan's real estate option. She puts $6,000 into her IRA for her 2019 Roth IRA contribution. She meets an investor at a local real estate group looking to borrow money to put a roof on a rental property. After discussing the needs of the property owner, they agree that Susan will give the property owner the funds for the roof replacement in exchange for an option on the property. So if you're thinking about the first slide and how I defined the option for you and said that the consideration is sometimes cash but doesn't have to be, think about this example quickly and how Susan maybe could offer to hire and pay for the roof to be replaced rather than giving the owner the money they needed for the replacement. So that might be a way that this transaction takes place without exchange of cash, for example. So again, they come to an agreement, and this is always the case with every investment, where you can see in this example, aside from the contribution, Advanta is not a part of this transaction just yet. So here I'm giving you basically the responsibilities of each person or entity. So you can see Susan is going to open and fund her Advanta IRA account. She found the investment and came to the agreement with the owner on the terms of the option. She submitted the proper forms, or in our case, the purchase authorization form for this investment. And basically all that is outlining the details of the investment itself. And she's going to read and approve all of the documents. So she's going to have her option contract and maybe quite possibly something like a mortgage to secure the option. And both or all of the documents that are included or a part of this investment are going to be in the name of the IRA. So she's going to turn all of that paperwork over to Advanta, and we are going to review that paperwork to make sure that the IRA is properly being represented. And I'll show you what that looks like in just a minute. She wired or once we have all of her forms and she basically is agreeing to this investment, we now have permission to go ahead and wire the funds for the option, and the investment is recorded and documents are sent to Advanta IRA. So Advanta IRA is safe keeping these original documents on Susan's behalf. And I don't know if I included it, but I definitely have it on the next example. But what does that look like as far as the paperwork and the vesting? Well, that would be Advanta IRA for benefit of Susan Smith, IRA number 1234. So everywhere that instead of Susan being the investor, it's going to be her IRA. And so that's very important because that demonstrates to the IRS that this investment is being made with the IRA and therefore is either tax-free or tax-deferred depending on the type of account that Susan has. And in this case, it's tax-free because it's a Roth IRA. So let's delve into this a little deeper here. The purchase price of the property agreed upon by Susan and the property owner was at today's value of $100,000. So what that means is that Susan gave the property owner $6,000 for the option to buy the property in 5 years at today's value. So that's where her earnings would be. So she exchanges the $6,000. She gets an option to buy the property in 5 years. And remember, she doesn't have to exercise the option. So where are the risks? Well, if the property value drops from $100,000 and in 5 years it's worth $80,000, well, then Susan may not want to exercise her option. And therefore, she's lost her $6,000. And so there are definitely things that you need to be aware of when you're making these types of investments. If at some point over the next 5 years, Susan is ready to exercise her option or follow through on this investment, I've given you a list of options that Susan can use in order to carry through on the investment. So she can buy the property for $100,000 using financing in the IRA, but again, You want to be cautious and understand the way the rules work for self-directed IRAs when you're making these investments. And so I wrote in there for you, subject to UBIT or UDFI, and must be a non-recourse loan, and then turn around and sell the property for the 130 that it's now worth after 5 years, giving her a $30,000 gain. Susan can sell her option to purchase the property to another investor. She might sell it at $10,000, and then in that case, her gain would be $4,000 on the $6,000 she originally invested. Susan may agree to sell the option back to the optioner or the property owner for the price of $20,000 because the optioner or owner likes and wants to keep the property. Or, in the case of, again, a down market, Susan can let the option expire and do nothing. She does lose her $6,000. So again, there could be great returns on this type of investment, or there may not be, and that goes with any type of investment, including in the stock market. But just to give you an example of how this investment works, and remember, she started out with just $6,000. And so even if she just agrees to cancel the option and so to speak, and sells it back to the property owner, she has some gain there. And so that may happen. And I have to tell you guys, based on my experience at the local exchange meeting, this is a strategy that I see pretty often. This is something that happens. Now, in this case, I kept it simple and we said buy the property itself, but maybe she only, in the option, she gets the option or the opportunity to buy a portion of the property or gain a portion of the equity in the property. And so there's a lot of different ways to move this investment strategy to make it work for all parties. So the next case study is partnering on real estate. And in this case, we're talking about an HSA and a traditional IRA. And I like this case study because we do see clients use this strategy, for one, and two, a lot of people say, well, I want to make my health savings contribution with Advanta, but I don't have an investment that's only $3,000 or only $5,000, only $7,000. And so this is a great way to get something like a health savings account or an education savings account working for you. So Paul makes his contribution of $7,000 for his family HSA to Advanta, and he finds a property for $70,000. So he decides to partner his HSA with his IRA to make the investment. The retirement account and the HSA will partner based on the funds they each contribute to the investment, no more and no less. So that's very important. When Paul goes into this partnership between his accounts, he can't say, well, I'd really like the HSA to have more earnings than just 10%, so I'm going to give it 50% ownership. That won't work because of IRS rules. So he has to only give the HSA 10% of the investment because that's all the HSA can afford to contribute at this time. And then income and expenses for the property will be based on the percentage of ownership. And again, here's responsibilities shown sort of step-by-step how it works. Paul will open and fund his IRA account and his HSA account. He finds the property or the investment, he makes an offer. So again, Paul's going to do all of this without Advanta. I always joke, you don't want me negotiating property price for you because you'll end up paying more than list price. So we're going to leave that up to you. We're not the professionals when it comes to that. He will submit purchase authorization forms for his accounts. We will look over the forms to make sure that everything from contract to close are correctly done in the name of the HSA and IRA as partners or tenants in common on the deed. And then everything will be signed by Advanta, and we will then wire the funds for closing. And now the investment is made in the name of the HSA and the IRA. And so under this blue heading here in the blue box, you can see an example of what that looks like with tenants in common on the deed. So Advanta IRA, for benefit of Paul's IRA number 1234, as to a 90% undivided interest, and Advanta IRA for benefit of Paul's HSA as to a 10% undivided interest. And again, percentages based on the amount contributed from the account. The title will show the IRA and HSA. Rent checks will be written directly to Advanta IRA, and Advanta IRA will handle separate accounting for income and expenses. So as money comes in from the tenant, we will look and see 123 Main Street. We put it into our system. We see that it's owned by the HSA for 10% and the IRA for 90%, and we will distribute the funds into those accounts in that way. And anytime Paul needs an expense paid and he puts in a request, then we're going to see again that we need to split that based on percentages of ownerships between those types of accounts. So what happens after close? Now, Paul's accounts own this property, and what does he do with the property? Well, expenses such as repairs, maintenance, taxes, and insurance are all paid directly from the IRA and HSA account, again, based on a percentage of ownership. And something that I wanted to point out here on this page is that it's very important that you consider what work may need to be done prior to the property being rented. Because let's say that Paul didn't buy a turnkey property. Let's say he bought something that needed work. Well, then that would mean he would have to calculate out the amount of work that needed to be done and allow for that within the amount of money he had left in the HSA. So in my example, he 100% invests all the cash he has in his HSA. But if this property needs work, then that isn't going to be something that he can do through the HSA. Maybe the HSA owns less of a percentages. Maybe it only owns 5%, so he can leave cash in the HSA to cover the HSA's share of that investment for any expenses. So that's very important. You almost have to have a crystal ball. Now, if you're buying a turnkey property, it has a tenant in place, and you're ready to go, that might be something you take into consideration as well. Remember that if you're short on funds, if you can make a contribution, then you can always do that to make up the difference. Your IRA and HSA can always borrow, but it has to be in the form of a non-recourse loan. And those accounts would then be subject to unrelated debt finance, income tax, or UBIT. So there's a lot of things to consider when you're making these investments, especially when you're talking about something like rental property. And so I'm going to turn it over now to Reneika, and she's going to talk about tax liens and give us the case study on how that works.
Thank you, Larissa. So case study number 3, we're going to talk about tax liens. We have many investors that prefer to invest in tax lien just simply because it offers them great flexibility, whether your investment strategy is you want interest returns or you do want to end up with the property. With tax liens, it does vary state to state, so that's something to be mindful of. And if we can go ahead and just bear with me one moment. Okay, so in this case study, we have Andrea. She opened up an ESA specifically for for her child, for her daughter. She's going to contribute her $2,000 per year. And she decided, okay, with $2,000, what can she put it in? She's done her due diligence. She's studied up on tax liens. Also, too, again, I would refer you back to our YouTube channel. We've had many experts and guest speakers come in and speak about tax liens. I know here in Atlanta, Chantel Owens is very popular, and when it comes to learning tax liens, so I would encourage you to go visit our YouTube channel, check out the recording specifically relating to tax liens. So back to Andrea, she opened up an ESA account for her daughter. She wants to invest $2,000. Again, it's her responsibility to understand how tax lien works, do her due diligence. She decide which county she wants to invest in, and again, it varies county to county, state to state. She's going to go ahead and go through the process of reaching out to her preferred county of where she wants to purchase that tax lien. She goes through the process of making those investments. She will work with her dedicated account manager here at Advanta, and that's again how we set ourselves apart from other competitors, is we provide you that direct point of contact. She'll let her account manager know, she's going to next month's tax sale. We'll work with her to make sure we have all of the cashiers checked out for in this case, if she wants to do the entire 2,000 or a little under, and of course, allow her to have those funds to make her investment or purchase the tax lien. For some reason, it's not. So again, with tax liens, again, it's very attractive to many investors, but it does vary state to state. So you do have to know, if you prefer Georgia or Florida, and I know Larissa can talk more on the state of Florida, but here in Georgia, it's 20%. You have you get 20% interest return, or if you end up with the property, you have to go wait for the 366 days, I'm sorry, to start the borrowing process if your strategy is, you want access to the actual property. Again, each county have the different rules, so you have to contact them to find out what their processes is. And then, of course, if the person do redeem the 20%, in this case, in the state of Georgia, that money will flow back into the IRA account. Or if you end up with a property, the actual, again, the property will be titled in the name of the IRA, depending on what your exit strategy is for that property, whether you're going to, wholesale it or fix and flip or, use it as a rental, those profits would flow back into the IRA as well. If you have expenses associated with that investment, so say you have, property taxes that you have to pay, it will be paid out of the IRA account. You can simply reach out to us, upload if there's a bill to be paid, like a property tax, upload that invoice or provide that bill to your account manager, and we can get it paid out of your IRA account.
Yeah, and I mean, that's, I think, very important to point out, because I do think tax liens are very attractive investment to those individuals that want to maybe start with a little bit of money. Although I have to tell you that I have many clients that have been very successful, and although they're beyond, just the contribution limit at this point, they continue to make those investments because they're very good at that strategy. But as Reneika pointed out, it's also important to note that state to state and sometimes county to county, of course, the way the process works is going to be a little different, but especially between states. So for example, Reneika mentioned that, if you hold a tax lien and it is not paid, then ultimately you could own the property at the end of that process in 366 days. So in the state of Florida, that is actually not how it works. Tax liens are sold. A property could go 2 years or more without paying the lien, and then what ultimately will happen is, if you're one of those lien holders, you could push for the property to go, into the auction, but you have no more right to purchase that property through the auction than any other individual bidding. And so just because you hold the lien, it doesn't entitle you to the property. You still have to go through the bidding process. And so an expense related there in the state of Florida would be that it does cost money to have the county push that property through the bidding process. And so that expense would be paid by the IRA. And so regardless of what state you're in, whether it's, Texas or Louisiana or wherever you might be, if you're investing in tax liens and deeds, just know what the state laws are and also what the process is for each of the counties that you would like to invest in, because that's very important. Before we really kind of wrap up here, I know we had some more questions pop up that I wanted to get to. Reneika, somebody's asking here in case study 2, how is earnest money handled when you go to contract for an IRA and HSA?
So when it comes to the earnest money, we can't give you tax, legal, or investment advice, but we typically ask you not to put down earnest money. We can, or if you do have to put down earnest money, at closing, Advanta, typically as the administrator, we would send the full amount, and then of course whatever the difference is for the original earnest money that you put down, we typically ask the closing agent or closing attorney to make sure that's funded back to you. But normally we ask you not to put down any money, because again, with the IRS rules and restrictions, if the assets is purchased directly in the IRA, it has to be paid by the IRA. But we've seen in the past where, okay, if you're putting down $100 personally, say the total amount is, $3,000, or, if you put down $100, Advanta will send the exact $3,000, and then that lets the closing agent or closing attorney know that they have to send that $100 down back to the individual.
And it's important to note that we can fund the earnest money as quickly as we have the contract and authorization from you. So let's say it's Tuesday and you finally go to contract after negotiations. You send us the contract and permission to send the earnest money and direction as to where we're sending it, and we can turn it around the same day. So there really shouldn't be a need for you to fund it. So we want to make sure that we're working with you to make sure we do it properly. Of course, there's always those times where you might go to contract on a Saturday or Sunday, and of course our offices are not open, but we can turn it around very quickly. So if you're working with somebody who agrees to wait until Monday morning to receive those funds, you reach out to your account manager and we will turn them around as quickly as possible. So that's very important. Contract and permission to send money, and then we can turn it around. Thank you for that question. We had another question here about self-direction and single member LLCs, or what we kind of consider a checkbook IRA, and whether or not those are allowed. And so we have a whole webinar based on checkbook control of an IRA. So again, search Advanta IRA in our on YouTube, and you'll find our YouTube channel, and then you can scroll through and you'll find the checkbook IRA. And so we're talking about using a single member LLC to gain checkbook control. And so what's important there is that you're abiding by IRS rules for self-directed IRAs, that your IRA is shown as the member on the operating agreement, which we will help you with. And that the flow of funds will then from there always be in and out of the LLC to make investments. But at any time you have a transaction that needs to be recorded by your third-party administrator, it goes through Advanta, meaning if you're making contributions to your IRA, if you're taking distributions from your IRA, all of that needs to be done by Advanta, not by you as the manager of that LLC. So that's very important to understand.
And to
Go
piggyback
ahead.
on that really quick, we do see tax lien investors use that checkbook control feature quite often.
Yeah, and that's a great point too, because the way that Advanta handles tax liens is going to be based on the county. And so if you're, for example, here locally, I'm in Pinellas County. And so if I'm going to invest in Pinellas County tax liens, Advanta is going to view that as one investment, regardless of the number of liens you hold. But if I'm going to invest in multiple counties, now I'm talking about multiple investments, different processes for each county, different amounts of deposits that they require, a different turnaround time for final payment. And so then we might see people consider using a single member LLC in order to make those investments. We're going to wrap up here, but I had a couple more questions I wanted to get to. I've heard that shares in an S corp are not allowed. That is true. You cannot invest IRAs into S corps. Now, if you're lending money, then it doesn't matter that it's an S corp. Just know that you can't take shares of the S corp back in payment. That's very important. Somebody else asks, what is a Forex account? It's foreign exchange or a foreign currency exchange. And basically Forex is not only a brand, but it also kind of is the category for investment. So you'll see people trading and buying foreign currency, and that's basically what a Forex account is. I want to lend money to my nephew in the form of a mortgage. Is that allowed? And the answer is it is allowed as long as it's for investment purposes. So again, we really didn't cover the rules today, but just know that your nephew is not expressly prohibited. However, if there is a current benefit to you in any way, that would make that transaction prohibited, meaning you don't expect him to pay back the loan. And again, it doesn't have to necessarily be that you did or didn't put it in writing. It all has to do with your intent. If your nephew was either going to have to live with you or buy a house of their own, his own, then that could be considered a current benefit. So there's a lot of different things that kind of go into that. So please feel free to reach out to either Reneika or myself, and we can go into that with you further. And one more quick question here about precious metals. You can make those investments into precious metals, and you're basically going to be doing that through a dealer. So Advanta doesn't have any one dealer that we recommend. We can tell you dealers offline that our clients have worked with in the past, but ultimately you're going to find a dealer that wants to sell those metals. So you're going to find those metals from a dealer, and then you're going to find a third party storage facilities, yep, depository, exactly. Thank you, Reneika, for holding those metals. So I know you and I always hear those store your IRA metal at home, your IRA gold in your safe at home, and unfortunately, Advanta's opinion on that is really not technically an arm's length transaction, and so therefore not within the rules, but you can certainly find the dealer that you want to work with and find the third party depository that you want to hold those metals with, and then certainly you can do that in your IRA. And so you would find the dealer, contact your IRA administrator or account manager with Advanta, and they would help you go through the purchase agreement and make the arrangements for sending it to the depository and ultimately paying the annual fee that goes along with holding those metals at a third-party depository. Contact information. Let me see, we might have it on the next slide. Here's the steps for opening accounts, and I think you guys really understand that from the case studies, but any additional questions you can let us know. We have events all the time. They're always no cost, no obligation. As a matter of fact, this is the second webinar that we're holding this week, as well as some outside events where we've been invited to speak and done recordings. Then we will post those to our YouTube channel as well. And so we didn't include our contact information here, so we're just going to go ahead and give it again, and then you guys can feel free to reach out to us. But my name is Larissa. I'm with the Advanta IRA office in Largo, Florida. Reneika is in Atlanta. Both of us can help anybody anywhere. We have clients nationwide and worldwide. And you can reach me at Greene, LGREENE at advantaira.com. And Reneika?
Yes, so I can be reached directly at R Lightbourne, LIGHTBOURNE at advantaira.com.
And you can, I have, my direct line is 727-754-9963.
And my direct line is 678-513-8913.
And I didn't see any other questions pop up in the chat box. So at this time, I'm going to close the webinar. I want to thank everybody for joining us again. This webinar is recorded. We will share the recording with you either tomorrow or Monday. And then if you want a copy of the slides, please feel free to reach out to us and I would be happy to share them with you. Thank you so much, Reneika, for doing the webinar with me.
Thank you as well. Be safe, everyone.